Imagine waking up one morning and realizing that for the last 10 years, money has been quietly working in the background, paying your bills while you slept. Not from a lucky bet, not from a flashy trade, from a simple plan that never needed a perfect day to start. That's the point of this message. The shortest path from zero to investor isn't clever. It's calm, it's repeatable, and it lets American business do the heavy lifting while emotions sit in the back seat. If this sounds boring, good. Boring builds wealth. Exciting usually sells products. The market will hand out plenty of adrenaline, but the job is not to feel smart today. It's to own more purchasing power later. That begins with a single decision. Become a lifetime buyer of productive assets. Stocks aren't lottery tickets. They are small slices of real companies that hire people, build things, raise prices when costs rise, and reinvest profits. Over time, the mathematics of ownership tilt the odds toward the patient, not the busy. Wealth compounds for those who let it. Start by defining the destination. The goal is simple. Transform part of every paycheck into future freedom. That means outrunning inflation without taking risks that could knock you out of the game. There are only a few levers that truly matter. How much you save, how consistently you invest, how little you pay in fees and taxes, and how long you stay invested. Everything else, the headlines, the hot takes, the forecasts, are weather. They feel important, they are not controllable. The good news is that success does not require controlling the weather. Here's the first big move. For almost everyone, the best first step is an ultra-low-cost S&P 500 index fund. Why? Because it gives instant ownership of hundreds of America's strongest companies, charges microscopic fees, and requires zero predictions about which sector wins next or what the Fed will do. It turns the hard question of which stock into the manageable question of how much can be saved, how often, and for how long. The fund doesn't panic, it doesn't boast, it just owns the market and lets compounding work while the news cycle screams for attention. Hook number one. If markets fell 30% next month, would that be scary or thrilling? For a buyer, it's a sale on future earnings. The catch is emotional. The market is designed to test temperament far more than intelligence. The edge most people overlook is not a secret formula. It is the ability to keep buying when prices are falling and keep buying when prices are soaring. The person who automates contributions and refuses to interrupt compounding is competing in a different league than the person who waits for certainty. Certainty never arrives. Discipline does. So make the decision before the first dollar goes in. Pick a fixed percentage of every paycheck. Automate it. Choose a schedule, every 2 weeks, every month, and treat it like rent for your future self. Reinvest dividends. Ignore forecasts. The world will deliver wars, recessions, elections, pandemics, bubbles, and booms. Across all of it, businesses will still wake up in the morning, serve customers, raise prices when costs rise, find efficiencies, and reinvest. The index captures that effort automatically. Your job is to keep feeding the machine. Let's talk mistakes, because avoiding the big ones is half the game. First, don't borrow to buy stocks. Leverage turns a temporary drop into a permanent scar. Second, don't churn. Every trade pays a toll, and most of those tolls go to someone else. Third, don't chase what just doubled. Recency bias makes what's popular feel safe and what's fallen feel dangerous. In reality, the price you pay determines your return. Fourth, don't confuse headlines with a plan. The economy has always had problems. Companies adapt. Owners who hold through storms benefit from the solutions. Costs deserve their own spotlight because they compound against you the same way returns compound for you. A 1% annual fee sounds small. Over decades, it can siphon an astonishing share of your gains. Favor funds with rock-bottom expense ratios. Avoid complex products sold with glossy language, elaborate charts, or promises of downside protection. Complexity is usually a sales feature, not a return driver. The prize goes to the investor who keeps more of what the market already offers. Now, a moment on fear. Volatility feels like danger, but for a net buyer, volatility is inventory going on sale. If shares are being accumulated every paycheck, falling prices buy more future earnings for the same dollars. That is arithmetic, not optimism. The real risks are paying too much, owning too little, or quitting early. None of those are required. A simple, automated plan makes good behavior the default and bad decisions harder to make in a moment of stress. Hook number 2. Imagine reaching a point where dividends from the index fund cover your car payment. Then a few years later, the groceries. That's compounding becoming visible. It starts as numbers on a page, then it sneaks into everyday life, and eventually it becomes freedom, the option to choose work, time, and place on your terms. That freedom is not gifted by brilliance. It's earned by consistency. What about picking individual stocks? It's optional, and only after the index habit is firmly in place. If the venture is undertaken, stay strictly inside a circle of competence. That means being able to explain the business in plain English, how it makes money, what moat protects it, how management allocates capital, and why that advantage can endure for a decade. If the explanation gets fuzzy, pass. There's no penalty for saying no. There is a steep tax for being wrong outside your circle. Think like an owner, not a trader. If the business would be happily owned for 10 years without checking the quote, the thesis probably rests on economics rather than excitement. Price matters, but perfect precision is a mirage. The goal is to pay a fair price for a wonderful business, not a cheap price for a melting ice cube. Favor companies with high returns on incremental capital, conservative balance sheets, and leaders who talk plainly about mistakes and priorities. Watch per-share value creation over years, not the daily stock tick. If this sounds like work, that's because it is, which is why the index fund remains the core. It lets the portfolio perform while life is lived. Let's build a simple, durable plan. Phase 1. Pick a broad, ultra-low-cost S&P 500 index fund. Set an automatic contribution from each paycheck. Reinvest dividends. Do this for a full year without fail. Phase 2. Once the habit is locked, read one annual report per quarter to sharpen business judgment. No screens, no shortcuts, just how a real company earns money and spends it. Phase 3, optional. Carve out a small owner S basket for a few understandable companies bought at reasonable prices, while keeping the index as the heavyweight. This structure provides both the reliability of the market and the engagement of ownership, without letting enthusiasm run the show. Funding the plan is where the leverage lives. Raise the savings rate every time income goes up. Capture half of each raise for investing before lifestyle expands to fill it. Keep a modest emergency fund so a broken transmission never forces selling great assets at bad prices. Treat tax-advantaged accounts as prime real estate. In taxable accounts, avoid unnecessary sales. Time is the ally, turnover is the enemy. Behavioral guardrails make this stick. Write a one-page policy that states the contribution rate, the schedule, the core fund, and the rule to do nothing during panics except continue buying. Commit to checking balances on a schedule, quarterly, not daily, because staring at volatility invites action, and most action hurts. Share the plan with a trusted person for accountability. When the headlines turn scary, read the policy instead of the news. Hook number 3. Picture a future downturn. The screen glows red. Commentators sound certain. Social feeds scream, "This time is different." The plan doesn't blink. Contributions go in on Friday, just like last Friday. Shares are purchased at lower prices. A year later, those buys look brave. 5 years later, they look obvious. 10 years later, they look small compared to everything compounded since. The only way to earn those outcomes is to be present when they're offered. Most people aren't, because fear rents space in their heads, evicted with rules written in calm weather. Let's address booms too, because they test discipline in a different way. When prices sprint and stories outrun earnings, the urge to improvise is powerful. Guard against style drift, rebalance lightly if allocations run hot. Remember that trees don't grow to the sky, and taxes and fees never take a holiday. The mission isn't to catch every wave, it's to own the ocean. The index does that for you. Your job is to avoid jumping off the boat to chase a shiny object. Taxes are another quiet force. Index funds tend to be tax efficient because low turnover defers capital gains, keeping more compounding inside the account. Prefer vehicles that minimize friction. Understand the basics, short-term versus long-term gains, and then arrange behavior to avoid unnecessary realization. Complex tax strategies promise a lot and often deliver confusion. Simplicity is not just easier, it's usually more profitable after fees and mistakes. Risk management done right is unglamorous. Real risk isn't the market dipping this quarter, it's failing to meet long-term goals or suffering a permanent loss of capital. Keep short-term cash needs out of the market. Match the time horizon of dollars to the time horizon of assets. Diversification through the index removes single company risk. Low costs and patience remove much of the behavior risk. That combination beats most complex hedges because it aligns with how compounding actually works. If starting late, the rules don't change. The intensity does. Save more, spend less, be ruthless about costs and taxes. Extend the horizon wherever life allows. Compounding still works, but it demands greater consistency and fewer detours. A 20-year plan started today is better than a perfect 10-year plan started someday. The best time to plant a tree was years ago. The second best time is whenever the shovel is in your hand. Now, a practical picture of progress. The first milestone is 12 straight months of contributions, rarer than it sounds and more powerful than most strategies. Next, watch dividends cross a symbolic mark. A phone bill, a car payment, a grocery run. Later, notice that bear markets bother you less because lower prices feel like bargains for a net buyer. Eventually realize that the portfolio has become a second income stream that doesn't ask for meetings, commutes, or permission. That's the emotional payoff of patience. If all of this still feels too easy, that's the trap. The path is simple. It is not easy. The daily grind of ignoring noise, staying the course, and letting small contributions grow into large numbers runs against human wiring. That's why automation, rules, and a focus on the few controllables are so valuable. They protect from the worst enemy in investing, the person in the mirror when markets move. So here's the blueprint, boiled down. Own the market through an ultra-low-cost index fund. Automate contributions from every paycheck. Reinvest dividends. Refuse to interrupt compounding. Keep costs microscopic and taxes minimal. If curiosity calls, study one business at a time and only buy what can be explained simply. And even then, keep those positions small compared to the index core. Measure progress by years of consistency and the growth of income, not by monthly performance. Live life while the portfolio quietly compounds. One last hook to carry into the week. Markets are very efficient at moving money from the active to the patient. Be the patient. Set the plan today. Make the next contribution automatic. Let American enterprise compound the results while attention is spent on better things than watching the tape. The rewards won't arrive with fireworks. They'll arrive the way a tree grows, quietly, then suddenly. And by the time the shade is needed most, it will already be there.